Business entity says that the owner is different from the business. Assuming you incur an expense for, let's say, 500,000 from the business money, from the business money, you decide to incur an expense from the business money for your own personal use, right? Please try and separate this. So, what is happening here is called withdrawal. You're going to reduce the capital you've introduced, right? Hello, this particular video is directed to business owners, students, and any other interested party. As you can see, business entity concepts. Funny enough, even professionals, even accountants tend to forget about this concept whenever they have a business. You understand? So, as an accountant, or as a businessman or woman, or as a student of knowledge, please let's make sure if we are handling a business, if we are establishing a business, at first it might be overwhelming, but please let's make sure we separate our personal transaction from the business as much as possible. Though at the very start, maybe you're unable to set up the company's account and what have you. So, but the best thing to do is to keep track of your expenses, keep track of your transactions that you've done so far, right? For the business, on behalf of the business, on the business. So, what are we trying to point out? Business entity says that the owner is different from the business. Yes, this concept will ensure that you have a clearer picture of what is happening on your business or in your business. So if you are making loss, it will clearly state it out that you're making loss. If you are making profit, it will also clearly state it out that you are making profit. But when you mix your personal finance together with your business finance, you might not be able to identify this problem. From the accounting equation where we have assets equals capital plus liabilities. This accounting equation will assist you a lot so that you know that the asset you have is as a result of the capital. This is you. So those money you are spending for the business, maybe at the very start, or even when you are down, when you are deep into the business, when you are already 1 year, 2 year, 3 years, at times might come when you might need to spend from your personal finance or maybe get money from somewhere to invest or to bring into the business. I would advise that any money that you are bringing into the business that is not coming from the business, maybe from outside or from your personal money, they can come in different ways. If it is from your own personal pocket, you are it's from your own personal pocket. You name it from your own personal pocket, right? It's coming from you. The best thing you should you should go is capital is as equity. Equity is the same thing as capital. So you recognize that money as equity. So this will definitely translate to the capital that you're investing. So you're investing into the business. So maybe you got the money from somewhere or from another deal and you decide to bring in that money into the business. Please recognize that transaction. I am not planning to pay yourself back. Maybe you want to invest into the business. The best way to bring it in is through this. And this is the double entry. How will the double entry look like? You are bringing it in through cash or you're bringing it in through fixed asset. They are all assets, right? So what you do is to debit asset account. Remember, in my last videos, asset account has a normal balance on the debit side. So if you are debiting asset account, it means the asset account is increasing, which is okay. So which is the plus. Then if you credit, the other entry will be credit owner's contribution or investment, which is equity account. So this also, remember the dear clip, this fall on the clip aspect, which is the capital, which is the capital. So you are debiting the asset amount, let's say with 100,000, and you're crediting your equity amount with 100,000. What happened? Your balance sheet is going to increase both sides. So this asset is going to be 100,000 equal to 100,000. Nothing happened to this. So it means your balance sheet is still perfect. This way, you recognize that you are a different entity from the business. Now, what if you decide to recognize this money you introduce into the business as a liability? So you are telling the business that you're expecting to be paid back in maybe number of days or months. This way, it's going to affect, it's going to come in as a liability, not as an asset, because you have to pay back that money, even if it is to yourself. So you are borrowing the business the money because you are a different entity from the business. In that case, we have a liability account, which is also, let's say, equal to 100,000. So this liability account falls under CLIP. Remember, I said CLIP, capital liability, income, provision, and payables. The liability, they are all credit balances. So if you post to their credit side, they are appreciating. It's good. So this is, you credit the liability account. This is already reflecting here. So we are having an additional 100,000 here. Then the cash that is coming in, which is the asset. Remember, it can still come in as in form of assets, fixed assets, maybe equipment, furniture and fittings, plant and machinery, or in form of cash, money, right? They are all under assets. This will also translate to 100,000. But remember, we have to credit one and debit one. So we are debiting an asset account, which is also fantastic, which is also correct. It's appreciating the normal balances at the debit side for all asset accounts. This way, what we are trying to discuss here, what we're trying to explain to ourselves, is that we should try as much as possible to separate our personal transactions from the business transaction, so that at the end of the day, we can clearly see if the business is making profit or not. Assuming let me take this out. Assuming you incur an expense for, let's say, 500,000 from the business money. You decide to incur an expense from the business money for your own personal use, right? Please try and separate this. So what is happening here is called withdrawal. You're going to reduce the capital you've introduced, right? Remember, from the D stands for withdrawal. I told you that the D, which is the drawings, reduces the capital. If you want to get more explanation about this DA clip, you can check my previous video that I made about the secret to understanding double entry system. So now you've spent this money for personal use. Now, as far as it is not for the business, maybe for your own personal use, what happens is withdrawal. Let's say you now recognize this transaction as an expenses in the business. Of course, you might want to run away from tax, but then every every transaction has a source document. And if the tax authorities are okay by that, fine. Maybe you went for a business meeting, uh, yes, for a business meeting, for instance, business travel, right? And you incur those expenses. But if truly, for this purpose of understanding why this business entity concept is important, so we're assuming you now recognize these expenses. Remember, in a profit and loss account, whereby you have revenue, you have cost of goods sold account, cost of goods sold. So revenue here minus cost of goods sold, you have your gross profit, which is this. Then from your gross profit, you remove operational expenses, and you arrive at your net pay, your net profit. So this is just a simple representation of profit and loss, right? Like I call it profit or income statement. So let's now show you something. So let's say we have a revenue of 100,000, and the cost to of goods sold, the cost of generating this revenue 100,000 is, let's say, 30,000. So I'm going to subtract this 30,000 from 100,000, which will give us 70,000. And from this 70,000, these operational expenses that we assume is for the business, which of course is for our personal use, which is, let's say, 50,000. You now recorded it on your own account as 50,000. What just happened is that you successfully reduce your net profit by 50,000, because these operational expenses, the expense you incur for your own personal use, is not an operational expenses. It's not for the operation of the business. It's for your own personal consumption. So that money is not supposed to come here, right? So the implication is that you're supposed to have a net profit of 70,000, assuming there was no operational expenses. But now you're having a net profit of 20,000, showing that your business underperformed. It underperformed. Remember, your net profit or net loss invariably is going to your balance sheet, which is a financial position, is going to add up to your capital. So if it's adding up to your capital, if you're having 20,000 adding up to your capital compared to having 70,000 adding up to your capital, of course, you want to agree with me that you want to go with 70,000. What is the proper way to record that transaction? Let's quickly look at the proper way of recording that transaction. So the best thing is to do is you still have your net profit as 70,000, which is correct. But that 50,000 that you withdrew from the business, from your personal expenses, what will happen is we are going to assume you have a capital balance of, let's say, 150,000, right? So if you come up, you have capital, just the T account, credit, and you have debit. Remember, capital is under clip, and I said the normal balance is at the credit side. So we're going to say our balance brought forward. Balance brought forward as let's say 150. Now the 150,000 at the credit side. This is the balance brought forward. But now there is a withdrawal of 50,000. So that is the drawings I was telling you about. So what are you withdrawing? Are you withdrawing it through cash? So let's use cash. So you're gonna have cash as 50,000. Left with balance carried down of 100,000. This is 150,000. And this is 150,000. Of course, we now have balance brought down of this 100,000. Now, this is the correct way. You still have a net profit as 70,000, but then your capital account has reduced to 100,000 because you withdrew 50,000 from the business for your own personal use. Then, how does it affect our accounting equation? So let's check and see. So let's say we have an accounting equation with a capital of 150,000, which is what we've already registered here. Then coming back to assets equals capital plus liabilities. Now, simple representation here is that the capital here is going to reduce by 50,000. So we're assuming this is already balanced. We're assuming this is already in balanced form. So let's just pick an amount. So let's say this is 150, which is what we have as our balance brought forward. And let's say this is 70, let me use 80,000. So 80 plus 150 should give us 230,000 if I'm not mistaken. So we have 230,000. So let's say this is the equation we have before this withdrawal, right? Now, the withdrawal will now bring out 50,000. So it means our cash, which is an asset, will reduce by 50,000. So if you minus 50,000 here, 230 minus 50,000 is going to give us, I think, 180. So I have 180,000, right? Equal to, remember, reduction also, our capital reduced by 50,000. So here is going to be 100,000, then plus 80. Nothing happens to our liability. So we are left with 180,000 equals 180,000. Fantastic. This is how you should record the withdrawal from the business for your personal use. Then I think we've already treated uh, introducing money into the business. I've also treated loan. Yes, so you loan the business a particular certain amount of money from yourself or from your friends and family or from a bank, whichever. But we are particular about your separating yourself from the business. This is the best way so that you would be able to quickly know if this business is profitable to you or not, if you are doing something wrong or not. But otherwise, if you keep on injecting your own personal money and the business is going down, you wouldn't know. You wouldn't know. So better still, try as much as possible to separate your personal life business, your personal finance from the business so that you can easily recognize a problem when it exists and when it occurs. Thank you for watching this video. If you have any question, don't hesitate to drop it on the comment section. As soon as you drop the question, we are here to reply. Please like the video, you can share the video, and subscribe to our YouTube channel. And don't forget to turn on your notifications so that you get notified whenever we make new, interesting, and engaging videos like this. Chop chop.